Before we begin today's analysis, a brief word. If you value disciplined, evidence-based financial insights delivered without hype or sensationalism, consider subscribing to this channel. We focus on rational strategy, historical context, and the psychology that separates successful investors from the crowd. You'll find the subscribe button below this video in red. A simple click helps you stay informed as markets evolve. Now, let's examine what's happening in silver markets and what it means for your financial decisions. Silver has entered what many holders are calling a fear spike. Prices have pulled back. Volatility has returned. And across forums, social media, and brokerage platforms, a familiar pattern is emerging. Holders are questioning their positions. New investors are freezing. The confident conviction of weeks ago has given way to doubt. But this moment matters, not because silver is crashing, not because the investment thesis has collapsed, but because this is precisely the inflection point where discipline separates long-term wealth builders from emotional traders. Here's what we know. Market pullbacks in precious metals are not anomalies. They are features of the asset class. They test resolve, they shake out weak hands, and if history is any guide, they often precede the most significant moves higher. Today, we're going to examine this pullback through a rational lens. We'll explore what's driving current weakness. We'll review historical patterns that put this moment in context. We'll discuss the psychology at play and the macroeconomic forces that continue to support silver's long-term case. Most importantly, we'll provide clear, actionable guidance for two distinct groups: those who already hold silver and are wrestling with fear, and those watching from the sidelines, wondering if this pullback represents opportunity. This is not about predictions. It's about preparation. It's about understanding the cycles that govern precious metals markets and positioning yourself to act rationally when others are driven by emotion. Let's begin. First, let's establish what's actually happening. Silver has experienced a sharp correction from recent highs. Depending on when you purchased, your position may be underwater. If you bought near the peak of the recent rally, you're likely looking at losses that feel significant. This pullback has been accompanied by increased volatility. Daily price swings have widened, trading volume has picked up, and sentiment, measured through various indicators, has shifted from bullish optimism to cautious concern. For many holders, this feels personal. It feels like a mistake. The confident thesis that led to your purchase now feels questionable. Understand this clearly. What you're feeling is normal. Market pullbacks trigger psychological responses that are hardwired into human behavior. Loss aversion, the tendency to feel losses more acutely than equivalent gains, makes every percentage point decline feel magnified. The fear is real. But fear is not the same as fact. Let's separate emotion from reality. Silver remains one of the most strategically important industrial metals in the global economy. Demand from solar energy, electronics, and electric vehicles continues to grow. Supply constraints persist. Central banks worldwide maintain loose monetary policies relative to historical norms, and debt levels across major economies remain elevated. None of these fundamental factors have changed because of a price pullback. What has changed is sentiment, and sentiment, while powerful in the short term, is notoriously poor at predicting long-term outcomes. To understand this moment, you must understand cycles. Precious metals do not move in straight lines. They never have. They never will. Silver, in particular, is known for violent price swings. It's more volatile than gold. It's more sensitive to industrial demand fluctuations. And it has a smaller market, which means that relatively modest capital flows can create outsized price movements. This volatility is not a bug. It's a fundamental characteristic of the asset. Throughout history, silver bull markets have been punctuated by savage corrections. In 2010 and 2011, during one of the most powerful silver rallies on record, the metal experienced multiple pullbacks exceeding 20%. Holders who sold in fear missed the subsequent moves that took silver to multi-decade highs. In 2016, silver rallied sharply before pulling back violently, shaking out investors who had just entered the market. Those who held through the correction or accumulated during weakness were rewarded in subsequent years. The pattern repeats because human psychology repeats. Every cycle brings new participants who believe this time is different. Every correction creates panic among those who lack historical context. And every recovery rewards those who understand that volatility is the price you pay for asymmetric upside potential. Ask yourself this question. If you believe in silver's long-term thesis, what has a temporary price decline changed about that thesis? If the answer is nothing, then your response should be strategic, not emotional. Let's examine historical precedent. Over the past 5 decades, silver has experienced numerous multi-month corrections within longer-term bull markets. In almost every case, these pullbacks have been characterized by similar features: rising volatility, negative sentiment, capitulation among weak holders, and pessimistic media coverage. And in almost every case, these pullbacks have proven to be accumulation opportunities for patient investors. Consider the 2008 financial crisis. Silver crashed alongside broader markets, falling from over $20 to under $9 per ounce in a matter of months. Panic was widespread. Investors who had been bullish on precious metals questioned their thesis as credit markets froze and deflation fears dominated headlines. What happened next? Silver rallied to nearly $50 per ounce over the following 2.5 years. The investors who bought during the 2008 panic, when fear was highest and conviction was lowest, captured extraordinary returns. The investors who sold at the bottom locked in permanent losses. History doesn't repeat, but it rhymes. The current pullback shares characteristics with previous corrections that preceded major moves. Sentiment has shifted from greed to fear. Weak hands are selling. And conversations have moved from how high can it go to is the rally over? This is the environment where opportunity is born. Not because pullbacks guarantee future gains, they don't, but because the conditions that create long-term value in any asset class are rarely accompanied by comfort and confidence. Let's talk about what's happening in your mind right now. If you hold silver and you're watching your position decline, you're likely experiencing a range of emotions: anxiety, regret, doubt, perhaps anger at yourself for buying, or at analysts who encouraged you to enter the market. These feelings are universal. Every investor, regardless of experience, faces them during drawdowns. The difference between successful long-term investors and those who consistently underperform is not intelligence or access to information. It's emotional discipline. Right now, your brain is working against you. It's emphasizing recent price action and extrapolating it into the future. It's highlighting the pain of losses while discounting the potential for recovery. It's searching for reasons to act, to do something, because inaction during loss feels unbearable. This is loss aversion in action. Studies in behavioral finance have consistently shown that investors feel the pain of losses approximately twice as intensely as they feel the pleasure of equivalent gains. This asymmetry drives poor decision-making. It causes investors to sell winning positions too early and hold losing positions too long in the hope of breaking even. But here's what matters. In precious metals, the most dangerous time to sell is often when the urge to sell is strongest. Market bottoms are characterized by maximum pessimism. By the time sentiment has improved and you feel comfortable buying again, prices have often already recovered substantially. The investors who build wealth in volatile asset classes are those who can override their emotional impulses with disciplined strategy. Can you do that? Can you separate how you feel from what you know? Now let's zoom out to the macroeconomic environment. Despite this pullback, the fundamental factors that support precious metals remain intact. In many cases, they've strengthened. Global debt levels continue to climb. Government spending across major economies shows no signs of meaningful restraint. Central banks, while adjusting policy rates in response to inflation, maintain balance sheets that are historically enormous. These conditions create long-term headwinds for fiat currencies and tailwinds for hard assets. Silver benefits from this monetary backdrop in two ways. First, as a precious metal, it serves as a store of value when currency purchasing power erodes. Second, as an industrial metal, it benefits from the infrastructure spending and green energy initiatives that governments are pursuing in response to climate and energy security concerns. Demand from solar panel manufacturing alone has grown exponentially over the past decade. Electric vehicles require significantly more silver than traditional combustion engine vehicles. 5G infrastructure, medical applications, and electronics continue to consume increasing quantities of the metal. Meanwhile, supply remains constrained. Primary silver mining is challenging and capital intensive. Much of the silver that comes to market is a byproduct of other mining operations, meaning supply doesn't respond quickly to price signals. This supply-demand dynamic creates structural support beneath the silver market. Short-term price movements are dominated by sentiment, speculation, and technical trading. But over longer time frames, fundamentals matter. And the fundamentals have not deteriorated because of a market pullback. If anything, the pullback has made silver more attractive on a risk-reward basis for those with appropriate time horizons. Let's discuss what indicators actually matter during moments like this. First, pay attention to physical demand. When paper prices decline but physical premiums remain elevated or increase, it signals a disconnect between speculative positioning and real-world demand. This disconnect often precedes price recoveries. Second, watch institutional positioning. Large speculators and commercial traders leave footprints in the market through their futures positions. When speculative positioning becomes extremely bearish, it often marks sentiment extremes that don't last. Third, observe correlation patterns. Silver typically correlates with gold, but the ratio between the two metals fluctuates significantly. When silver underperforms gold during a correction, it often means silver has further to fall in the near term, but also more explosive upside potential during the next leg higher. Fourth, monitor industrial demand data. Manufacturing indices, solar installation figures, and electric vehicle production numbers provide insight into the real economy's appetite for silver. Strong underlying demand creates a floor beneath prices that speculation alone cannot. Fifth, pay attention to currency markets. Silver is priced in dollars, so dollar strength or weakness directly impacts the metal's price in dollar terms. A surging dollar can pressure silver even when underlying fundamentals remain constructive. None of these signals provide precise timing tools. Markets are complex systems influenced by countless variables, but together they help you distinguish between temporary price weakness and genuine deterioration in the investment case. Right now, most of these signals suggest that the pullback is cyclical, not structural. That doesn't mean prices can't fall further in the short term. They absolutely can, but it does mean that the long-term thesis remains intact for patient investors. If you currently hold silver, you face a decision: hold, add, or sell. Let's examine each option rationally. Selling now locks in losses and potentially removes you from future upside. It also eliminates ongoing psychological stress if the position has grown too large relative to your risk tolerance. If you need the capital for immediate expenses, or if the position was always speculative rather than strategic, selling might be appropriate regardless of future price movements. But if you purchase silver as part of a long-term allocation strategy, selling during a pullback contradicts that strategy. You're not trading. You're positioning for a multi-year outlook. Short-term volatility is the cost of that positioning. Holding requires no action but demands emotional fortitude. You must accept that further downside is possible. You must resist the urge to constantly check prices. You must maintain conviction in your original thesis, or acknowledge that the thesis has changed in a meaningful way. Adding to positions during weakness, often called dollar cost averaging, can lower your average entry price and increase potential returns if the market recovers. But this is only appropriate if you have additional capital allocated to precious metals. If your overall portfolio remains balanced, and if the addition doesn't create emotional stress that disrupts your sleep or daily life. Here's the key principle. Your decision should be based on your overall financial strategy, not on fear or hope. Review your original rationale for purchasing silver. Has anything fundamental changed? Or has price volatility simply triggered emotional responses that you need to manage rather than act upon? For most holders who purchased as part of a diversified, long-term strategy, the appropriate response is to hold or add modestly while maintaining strict position sizing limits. This keeps you in the game without overextending yourself emotionally or financially. If you've been watching silver but haven't yet entered a position, pullbacks create potential opportunity. But opportunity comes with caveats. First, recognize that calling exact market bottoms is impossible. Prices can always go lower. The current pullback could extend further before stabilizing. Anyone claiming they can time the perfect entry is either deluded or dishonest. What you can do is assess whether current prices offer favorable risk-reward characteristics, given a multi-year time horizon. Ask yourself, if I purchase today and prices fall another 15 or 20%, can I hold without panic? If the answer is no, you're not ready to invest, regardless of how attractive current prices might appear. Second, consider position sizing carefully. Precious metals should represent a meaningful but not dominant portion of your portfolio. Traditional guidance suggests anywhere from 5 to 15% allocation depending on your overall financial situation, risk tolerance, and conviction level. Starting with a smaller position that you can add to over time is often wiser than committing all intended capital at once. Third, understand that silver is not a short-term trade, unless you're an experienced trader with strict risk management protocols. For most investors, silver is a strategic hold that provides portfolio diversification, inflation protection, and exposure to industrial demand growth. The timeline for this investment should be measured in years, not months. Fourth, decide whether you're purchasing physical metal or paper exposure through ETFs and similar vehicles. Physical provides true ownership and eliminates counterparty risk, but comes with storage considerations and premiums above spot price. Paper exposure is convenient and liquid, but introduces counterparty risk and may not track physical metal perfectly during market stress. There's no universally correct answer. The choice depends on your specific situation and objectives. For potential investors, the current environment offers something valuable: the ability to enter without chasing. You're not buying into euphoria and momentum. You're buying into fear and doubt. Historically, these are the conditions that set up favorable long-term outcomes, but only if you have the discipline to hold through continued volatility. Whether you hold silver already or are considering entry, risk management must guide your decisions. First principle: never allocate capital to any investment that you cannot afford to lose entirely. While precious metals are established asset classes with centuries of history, they are volatile and can remain depressed for extended periods. Your silver position should not threaten your financial stability or force you to sell at inopportune times due to cash needs. Second principle: diversification within precious metals. If you hold silver, consider whether you also hold gold or other hard assets. Each metal has distinct characteristics and performance drivers. Diversification within the precious metal space can smooth volatility. Third principle, stop-loss discipline for traders versus patience for strategic holders. If you're trading silver, you need hard stop-loss levels to limit downside. If you're holding strategically, stop-losses can be counterproductive, forcing you out at precisely the wrong time. Know which category you fall into and act accordingly. Fourth principle, regular portfolio rebalancing. As asset values fluctuate, your portfolio's allocation shifts. Periodically rebalancing back to target allocations forces you to sell what is appreciated and buy what has declined, which is emotionally difficult but strategically sound. Fifth principle, emotional position sizing. If your silver position keeps you awake at night or causes constant anxiety, it's too large regardless of what percentage of your portfolio it represents. Peace of mind has value. Size your positions so that you can hold through volatility without psychological distress. These principles aren't exciting. They don't promise quick wealth. But they're what separates investors who survive multiple market cycles from those who blow up their portfolios chasing returns. We must address the dollar's role in current silver weakness. The US dollar has strengthened against most major currencies in recent months. This strength creates headwinds for dollar-denominated commodities like silver. When the dollar appreciates, foreign buyers find silver more expensive in their local currencies, which reduces demand. Simultaneously, investors often view dollar strength as reducing the need for alternative stores of value. This relationship is well established. Dollar strength typically pressures precious metals, and dollar weakness typically supports them. But here's what matters for long-term investors. Dollar cycles themselves are cyclical. Periods of dollar strength are followed by periods of weakness. The long-term trend in purchasing power for all fiat currencies, including the dollar, is downward due to monetary expansion. Current dollar strength, while pressuring silver prices in the short term, doesn't negate the long-term case for holding hard assets. In fact, dollar strength during precious metals corrections often creates attractive entry points for investors who understand that currency strength is relative and temporary rather than absolute and permanent. The question isn't whether the dollar will remain strong forever. It won't. The question is whether you can maintain your position during the period when dollar strength pressures silver prices. For strategic holders, dollar strength during a silver pullback is noise, not signal. It explains short-term price action but doesn't change multi-year fundamentals. Let's address a critical distinction: market timing versus time in market. Market timing is the attempt to buy at the exact bottom and sell at the exact top. It's seductive. It promises maximum returns with perfect execution. And it fails consistently for the vast majority of investors who attempt it. Why? Because it requires being right twice, when you exit and when you re-enter. Each decision point introduces opportunities for error driven by emotion, incomplete information, and randomness. Time in market is the alternative approach. You establish a position based on fundamental conviction. You size it appropriately for your risk tolerance, and you hold through volatility, understanding that the power of an investment thesis plays out over years, not weeks or months. Data across asset classes consistently shows that time in market beats timing the market for most investors. This doesn't mean buy and forget. It means buy with conviction, monitor your thesis, and hold unless the fundamental case deteriorates meaningfully. For silver holders, we're experiencing this pullback. The critical question isn't, can I time the bottom to buy back lower? The critical question is, do I believe in the long-term case, and does this pullback change that case? If the answer is that the fundamental case remains intact, then attempting to time a marginally better entry by selling now and buying back later introduces more risk than it eliminates. You might sell here and watch silver rally without you. You might capture a bit more downside but miss the reversal. Or you might successfully time a round trip, reinforcing timing behavior that will eventually cost you significantly in the future. Time in market, with appropriate position sizing, is the more reliable path for most investors. One element that distinguishes silver from gold deserves deeper examination: industrial demand. Approximately half of annual silver demand comes from industrial applications. This creates a fundamental floor beneath prices that gold, which is primarily monetary and jewelry-driven, lacks. Solar panel manufacturing is the fastest growing source of industrial silver demand. Each solar panel requires a relatively small amount of silver, but global solar installation growth has been exponential. Countries worldwide are committing to renewable energy targets that require dramatic expansion of solar capacity. This demand is not speculative, it's structural. It's driven by energy policy, climate commitments, and economic incentives that transcend silver's price movements. Electric vehicle production is another growing demand source. The electrification of transportation requires significantly more silver per vehicle than traditional automobiles. As EV adoption accelerates globally, this demand stream grows. 5G networks, medical applications, electronics, and other industrial uses continue to consume silver at rates that generally increase rather than decrease over time. Here's why this matters during a pullback. Industrial consumers don't stop buying silver because speculative traders are selling futures contracts. Manufacturers need the metal to produce goods. When prices decline, industrial buyers often increase purchasing to lock in lower costs. This creates a natural source of demand that emerges during price weakness and helps stabilize markets. For investors, industrial demand means that silver isn't purely a monetary metal vulnerable to shifts in sentiment. It has real-world use cases that create ongoing consumption regardless of investment flows. This distinction becomes increasingly important during pullbacks when investor demand wavers, but industrial demand persists. Let's discuss contrarian investing principles. Markets are driven by supply and demand, and in financial markets, supply and demand are heavily influenced by sentiment. When everyone is bullish, demand has already pulled prices higher. When everyone is bearish, selling has already pushed prices lower. The opportunity emerges when sentiment reaches extremes because extremes don't persist. Right now, sentiment in silver has shifted from bullish to cautious or bearish. Conversations have moved from excitement to doubt. This shift is palpable in forums, social media, and market commentary. This environment is uncomfortable. It doesn't feel like opportunity. It feels like danger. And that's precisely why it often is opportunity. Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful isn't just catchy wordplay. It's a description of how wealth is actually built in markets. You cannot buy low and sell high if you're only comfortable buying when everyone else is buying. By definition, that's buying high. Buying low requires accepting discomfort. It requires acting when the prevailing narrative suggests you shouldn't. It requires trusting analysis over emotion. This doesn't mean blindly buying every decline. It means recognizing when fear has created prices that don't align with underlying fundamentals and having the courage to act. For silver, the question is whether current prices, in light of structural supply constraints and growing industrial demand, represent value despite the negative sentiment. If your analysis suggests they do, then the discomfort you feel about buying now is a signal that you're acting like a contrarian rather than following the crowd. And over long time horizons, that's generally where outperformance originates. Let's be explicit about errors that destroy capital and derail plans during market volatility. Mistake 1, emotional decision-making. Buying or selling based on how you feel rather than what you know leads to consistently poor outcomes. If you feel compelled to act due to fear or greed, step away from your portfolio for at least 24 hours before making decisions. Mistake 2, over-leveraging. Using margin, leverage, or borrowed money to purchase silver magnifies both gains and losses. During volatile periods, leverage can force liquidation at the worst possible times. If you're leveraged in silver right now, reducing that leverage should be a priority. Mistake 3, position sizing beyond your risk tolerance. If your silver position is large enough to cause sleepless nights, it's too large. No investment is worth compromising your mental health or decision-making clarity. Reduce position size to a level that allows you to hold through volatility. Mistake 4, abandoning your investment thesis without new information. If you purchased silver for specific fundamental reasons, and those reasons haven't changed, a price decline isn't new information. It's market noise. Selling because price has dropped contradicts rational decision-making. Mistake 5, attempting to day trade in and out of positions. For most investors, short-term trading in volatile assets like silver results in loss of capital through poor timing, emotional decisions, and transaction costs. If you're a strategic investor, trade like a strategic investor, not a gambler. Mistake 6, ignoring portfolio balance. If silver or precious metals have grown to dominate your portfolio due to conviction or previous gains, rebalancing protects you from concentration risk. Diversification isn't exciting, but it's protective during market dislocations. Mistake 7, listening to promotional content over disciplined analysis. Anyone promising that silver will definitely hit specific price targets or that you'll definitely get wealthy by buying now is not providing investment guidance. They're providing entertainment or selling you something. Distinguish between education and promotion. Mistake 8, failing to define your time horizon. Are you investing for 6 months or 6 years? Your time horizon should determine your response to volatility. Short time horizons and volatile assets are a dangerous combination. If you need the capital within the next year, silver may not be appropriate regardless of the fundamental case. Mistake 9, paralysis from seeking perfect information. You will never have complete certainty. No one will ring a bell at the exact market bottom. Waiting for perfect clarity means waiting until the opportunity has passed. Make decisions based on probability and risk reward, not certainty. Mistake 10, comparing your decisions to others' outcomes. Someone else may have timed this pullback perfectly and sold at the peak. Their success doesn't mean your approach was wrong, especially if your approach is strategic rather than tactical. Focusing on others' results rather than your own process is destructive. Avoid these mistakes, and you eliminate most of the behavioral factors that turn market volatility into permanent capital loss. We must address inflation's ongoing role in the precious metals narrative. Inflation has moderated from the peaks of recent years, but structural inflationary pressures remain embedded in the global economy. Supply chain reconfiguration, deglobalization trends, energy transition costs, labor market tightness in developed economies, and unprecedented debt levels all create upward pressure on prices. Central banks have responded to inflation with rate increases, which temporarily strengthens currencies and pressures hard assets. But the long-term trajectory of monetary policy remains expansionary relative to historical norms. Governments cannot afford to maintain truly restrictive monetary policy for extended periods given their debt burdens. Eventually, policy pivots back toward accommodation, which supports precious metals. Silver benefits from this dynamic more directly than many realize. Industrial demand grows during economic expansion and infrastructure investment, both of which are often supported by accommodative policies. And silver's monetary characteristics provide a hedge when those policies erode currency purchasing power. The current pullback has occurred during a period when inflation concerns have receded from headlines. Central banks have tightened policy, and real interest rates, while still low historically, have moved higher. This is the environment where precious metals often struggle in the short term. But it's also the environment where positioning for the next cycle becomes attractive. The investors who bought silver in 2018 and 2019, when inflation fears were dormant and metals were unloved, captured the explosive moves of 2020 and early 2021. The parallel to today is striking. Metals are pulling back. Inflation concerns are lower than a year ago, and positioning has become less crowded. If history is a guide, these are the conditions that precede the next leg higher, not the end of the cycle. A brief technical note on the silver-gold ratio provides useful context. The ratio between silver and gold prices fluctuates significantly over time. When the ratio is high, meaning it takes many ounces of silver to buy 1 ounce of gold, silver is relatively cheap compared to gold. When the ratio is low, silver is relatively expensive. Historically, the ratio has ranged from as low as 15 to 1 in periods when silver strongly outperforms to as high as 100 to 1 during extreme stress or silver weakness. During this pullback, the silver-gold ratio has widened, meaning silver has underperformed gold. This is typical during precious metals corrections. Silver's higher volatility means it often falls harder than gold during sell-offs. But this pattern also means that silver often outperforms dramatically during recoveries. When precious metal sentiment improves, silver frequently posts percentage gains that exceed gold by substantial margins. For investors, a widening silver-gold ratio during a pullback can signal two things: short-term pain and long-term opportunity for those positioned in silver before the ratio contracts. This isn't a guarantee. Ratios can remain at extremes longer than seems rational, but it's a pattern worth understanding if you're evaluating silver's risk-reward proposition during this pullback. Let's zoom out to central bank policy and global monetary conditions. Despite recent tightening cycles, central banks remain the dominant force in financial markets. Their policy decisions influence liquidity conditions, currency values, and risk appetite across all asset classes. The current environment features central banks attempting to control inflation without triggering severe economic contraction. This is a difficult balance, and history suggests it's rarely achieved cleanly. The likely path forward involves periodic policy adjustments as data evolves, but the long-term trend remains one of currency debasement through monetary expansion. No major economy has demonstrated willingness or ability to truly normalize monetary policy to pre-2008 standards. This reality supports the fundamental case for holding hard assets like precious metals as part of a diversified portfolio. Silver's pullback hasn't occurred because central bank policies have suddenly become sound and sustainable. It's occurred because short-term focus has shifted to policy tightening and away from the longer-term implications of structural monetary expansion. For strategic investors, this distinction matters. Short-term price movements reflect sentiment shifts. Long-term price potential reflects fundamental realities. If you believe that fiat currency management remains questionable and that monetary authorities will ultimately choose inflation over deflation when faced with debt burdens that are otherwise unmanageable, then the fundamental case for silver remains intact. There's a specific psychological phase that occurs during market corrections that's worth understanding. After an initial decline, there's often a period where prices stabilize or bounce modestly. Holders feel relief. Perhaps the worst is over. Perhaps recovery is beginning. Then prices decline again, often to new lows. This second leg down is psychologically devastating. It breaks the hope that the initial stabilization created. It triggers a sense of futility. Maybe this really is different this time. This is the valley. This is where capitulation happens, where holders who maintained conviction through the initial decline finally throw in the towel. And this is often, not always, but often, where the actual bottom forms. Not because capitulation guarantees a bottom, but because capitulation represents the exhaustion of selling pressure. Once the investors who were going to sell have sold, there's no one left to push prices lower unless fundamentals deteriorate. If silver enters this psychological valley and you find yourself feeling that sense of futility, recognize what's happening. You're experiencing a predictable emotional cycle that has occurred in every bear market and correction throughout history. The investors who build wealth are those who can recognize this cycle, acknowledge the emotions they're experiencing, and respond strategically rather than emotionally. This doesn't mean ignore your feelings. It means don't let your feelings drive decisions that contradict your strategic plan. Let's establish appropriate expectations about what comes next. No one knows exactly when this pullback will end. No one knows whether silver will decline another 10% or begin recovering tomorrow. Anyone claiming precise knowledge of future price movements is not to be trusted. What we can assess is probability based on historical patterns, fundamentals, and sentiment indicators. The probability that silver's long-term trend higher has ended seems low given structural supply constraints, growing industrial demand, and ongoing monetary expansion globally. The probability that short-term volatility will continue seems high, given the nature of precious metals markets. The probability that patient, disciplined investors will look back on this pullback as an opportunity seems higher than the probability that they'll regret holding through it, assuming their position sizing is appropriate and their time horizon is measured in years. This is probabilistic thinking. This is how rational investors approach uncertain environments. You don't need certainty to make sound decisions. You need a reasonable assessment of probabilities, combined with position sizing that allows you to be wrong without catastrophic consequences. If you're positioned appropriately in silver, relative to your overall financial situation, you can afford to be wrong about near-term timing, while still benefiting from long-term trends. If you're overpositioned, no amount of conviction about fundamentals will protect you from the psychological pain of volatility. Know the difference. Here's what you need to understand as we move toward concluding this analysis. You are not powerless in this situation. You have agency. You have the ability to make rational decisions that serve your long-term interests, regardless of short-term market movements. The market doesn't care about your emotional state. It doesn't care whether you bought at the top or the bottom. It doesn't care whether you're anxious or confident. The market will do what it does based on the collective actions of millions of participants responding to countless variables. What you control is your response, your position sizing, your emotional discipline, your commitment to strategy over impulse. If you've made mistakes, acknowledge them without self-recrimination. Every investor makes mistakes. What matters is whether you learn from them and adjust your approach. If you're positioned appropriately and your thesis remains intact, then holding through volatility isn't a sign of stubbornness, it's a sign of discipline. If you're considering entry and you've done the work to understand what you're buying and why, then acting while others are fearful isn't recklessness, it's contrarian investing. The empowering truth is that volatility creates opportunity for those prepared to embrace it. And preparation isn't about predicting what will happen. It's about positioning so that multiple outcomes can work in your favor. As we conclude, let's return to first principles. Silver has entered a pullback. Fear has replaced confidence for many holders. Doubt has replaced conviction. This is normal. This is cyclical. This is the reality of volatile asset classes. Your response to this moment will define your long-term outcomes more than the market's short-term movements. If you panic and sell at a loss, abandoning your strategy because of discomfort, you transform paper losses into permanent ones. You remove yourself from potential recovery, and you reinforce behavioral patterns that will harm you in every future market cycle. If you hold with discipline, understanding that volatility is the price of admission for assets with asymmetric upside potential, you remain positioned for long-term trends that transcend short-term fear. If you're a potential investor evaluating entry, you're facing a market that's less crowded, less confident, and more fearful than it was weeks ago. History suggests this is a more favorable environment for patient capital than the euphoria that preceded it. The path forward requires no genius. It requires no perfect timing. It requires discipline, appropriate position sizing, and a time horizon that allows fundamentals to matter more than sentiment. Silver's fundamental case, structural supply constraints, growing industrial demand, and ongoing monetary expansion remains intact. The pullback doesn't change these realities. It tests your ability to maintain perspective when prices don't cooperate with your expectations. This test is valuable. It separates those who understand what they own from those who are chasing momentum. It separates strategic investors from emotional traders. Markets reward patience and punish impatience over long time horizons. This pullback is your opportunity to demonstrate which category you belong to. Remember, the investors who build lasting wealth are not those who avoid volatility. They're those who endure it with discipline while others capitulate. The silver fear spike is real. The opportunity it creates for disciplined investors may be equally real. Your response will determine which side of that equation you end up on. Stay disciplined, stay rational, stay focused on your strategy, not your emotions. Thank you for your time and attention. If you found this analysis valuable, consider subscribing for continued coverage as these markets evolve. The subscribe button is below in red. Until next time, invest wisely.